Today marked a turning point in U.S. monetary policy. After 9 months on pause, the Federal Reserve finally decided to cut interest rates for the first time in 2025. This wasn't seen as just a technical adjustment, more so as a statement. So for the first time in this cycle, Jerome Powell made it completely clear that inflation is no longer the only boogeyman in the room, and that there's this other growing concern for officials over there at the Fed, which is the labor market. Once seen as unshakably strong, it's now flashing warning signs big enough to move the Fed. But today, the Fed officials have approved a quarter-point cut, lowering the Fed funds rate by 25 basis points. 11 of the 12 voting officials backed this move, with one notable dissent. New Fed Governor Stephen Myron, fresh off of his White House role, freshly appointed by Trump, wanted to go bigger with a half-point cut. So at the press conference today, Powell said something striking. Back in July, he mentioned downside risk 6 times, and today he didn't hedge. He said that downside risk is now a reality. So I'm about to play a video for us, and the question Jerome Powell was asked was whether the Fed cut today was for insurance against a weakening labor market, so them kind of shooting ahead of the running deer, reacting so the labor market could react to them, or because a downturn is already in place and they're reacting to a downturn in the labor market. So let's watch this video.
Yeah, I think you could think of this in a way as a risk management cut, because if you look at the SEP, actually the projections for growth this year and next actually ticked up just a little bit, and inflation and unemployment didn't really move much. So what's different now? What's different now is that you see a very different picture of the risks to the labor market. You've seen, we were looking at 150,000 jobs a month at the time of the last meeting, and now we see the revisions and we see the new number.
So he just mentioned the revisions that we've been covering on this channel for quite a bit.
And I don't want to put too much emphasis on payroll job creation, but it's just one of the things that suggests that the labor market is really cooling off. And that tells you that it's time to take that into account in our policy.
And all through his press conference, Jerome Powell mentioned the labor market cooling, that it's more of a concern now. So he really stresses that the Fed is leaning harder into its maximum employment mandate after a long period of being hyper-focused on inflation, which is a major narrative shift. So why is that the case now? Why haven't they done this in the past? So Powell pointed out 2 major things. First, the labor market weakness, which job creation has slowed to a level below the so-called break-even rate. Now, the number of jobs needed just to keep the unemployment rate stable is what that is, and that's a major red flag. The second thing being tariffs and inflation risks fading away. So while tariffs have added some kind of cost bump to goods and services, the Fed thinks that those effects are likely to be short-lived, those one-off kind of deals, a one-time price increase. So the inflation risks are still there, but they're not as threatening as they were earlier this year. So if we put it pretty simply, the inflation scare is cooling, but the job market is also cooling, but we got to catch, it's cooling faster. Now, let's turn our focus to what's called the SEP, which is the Federal Reserve's new summary of economic projections. And what this is it tells us a real story, and what it is a quarterly report released by the Federal Reserve presenting the economic forecasts of the members of the FOMC. Now, what we're looking at is, if we scroll down and you could find this report, we're going to zoom in, and what we want to look at are the updated median forecast compared to June, the last time we got this projection. And I think y'all could see where I highlighted. Let me just double check. Yeah, y'all could kind of see that here. I'll zoom in a little bit more for us. So look at these highlighted figures right here. We see GDP growth for 2025 was revised a bit higher from 1.4% to 1.6% for 2025. That's a modest but meaningful upgrade, suggesting the Fed still sees growth despite labor weakness. Unemployment rate, it stayed pinned at 4.5% for 2025, but they now see it holding higher for longer with 4.4% in 2027 instead of dropping toward the 4.2% earlier. Now, if we translate this into English, the Fed expects a sticky labor market slowdown, which is no bueno. We don't want that. We don't want to see that. Then core PCE, we skipped over the regular PCE inflation because core PCE strips out some of those volatile segments like food and energy. Core PCE inflation dropped from 3.1% in June's projection to 2.6% for 2025. And that's a huge downward revision, meaning that they see price pressures easing faster than previously thought. So maybe these tariffs are one-offs. So this combination, lower inflation, slightly stronger GDP, higher unemployment, what this does is paints a very mixed picture. And in this picture, growth survives, but workers feel the pain. Now, then there's this dot plot, the infamous dot plot where the Fed officials literally put dots on a chart to show where they think rates are heading. So we're going to scroll down, and it's right here. It looks like Braille. What we're looking at is 2025. So I kind of zoomed in a little bit much, but you could see right here, it's just this first set of dots. And for 2025, most officials now see the Fed funds rate falling into the 3.75 to 3.5% range by the end of the year, this year, 2025. And that falls right in line with markets' expectations, which futures traders are pricing in through the CME Fed Watch tool. So if you go to CME Fed Watch tool, we go down to December 10th's meeting. What we see is that right now, 79.9% expect the Fed to fall within this current range right here. So both the Fed and traders are expecting about another 50 more basis points of cuts this year. It kind of just depends on where you're reading though, because some of these larger banks think 3 to even 4 more cuts, which, think about it, there's only 2 more meetings this year, October 29th and December 10th. So if they're expecting 3 or 4 more cuts, for example, but there's only 2 more Fed meetings this year for interest rate decisions, what they're pretty much saying is that they're expecting 2 cuts of 25 basis points. So maybe a 50 basis point cut here in October 29th, or a 50 basis point cut in December 10th. So pretty much 1 cut equals 25 basis points. But this is what today's move matters so much. This is why. It isn't just about this cut. It's about what happens in October and December, which we got large catalysts that'll come up. These numbers are likely to change, but the Fed is signaling that consecutive cuts are now on the table and almost to expect them in a way. Now, markets love clarity, we know that, but they hate when everything is already priced in. So right after the Fed's announcement, stocks and bonds popped higher, but within minutes, those gains completely faded away. So by close, what we've seen is that the Dow finished up a little bit higher, closing up 0.57%. The S&P 500 slipped 0.1%. The NASDAQ fell 0.33%. And this happened because investors already bid up assets heading into this meeting. They already priced it in. So that sell the news reaction wasn't surprising. And we've been talking about this on this channel for quite a bit. This was expected to happen at some point. And after the Fed is when everybody was expecting it to happen. And then CNBC, if we pull that up right here, we can see that the 10-year Treasury yield ticked up slightly up to 4.83%. And the reason why is because the Fed is shifting focus to save jobs, which implicitly means that they'll tolerate inflation running a little bit more hot. That's not great for bond prices long term. So yields crept up a little bit higher, because if you're expecting inflation to run up a little bit hot, and this is just kind of my opinion, if inflation exists, assets tend to perform better, because think about, like, the price of your goods gone up, so you're able to sell a little bit more. You might have a little bit more margin, for example. Who wants a boring bond when you could just buy a stock? So in order to compete with some of these stocks that might perform well during inflationary periods, yields go up to, hey, come buy some of us. Come get some of this juicy yield. So that's kind of where the sequence falls into play. But this meeting was more than just a policy shift. It was a signal. So for months now, Powell has emphasized inflation. Today, he emphasized employment instead, and that pivot changes really how markets will interpret every piece of data going forward. So we also got strong retail sales. That keeps growth afloat, but it won't stop cuts. And speaking of retail sales, that was mainly along the higher income earners. So the middle class and the lower class earners, they're really feeling the pain right now. It's kind of hot in this room. Literally, like I'm starting to sweat right now. Rising unemployment claims, that's fuel for deeper easing. Inflation holding above 2%, which is the Fed's goal, that 2% target. The Fed may let it ride as long as jobs are weakening. And the real tension now is between Powell's cautious approach and voices like Governor Myron, who already wanted a half-point move at this interest rate decision meeting. So if the labor market deteriorates faster than already expected, the Fed may have to accelerate their cuts and start dropping a lot larger than they are right now. So here's where we stand. Rates are finally moving lower, but not because of the inflation fight being over. It's because the Fed sees the job market cracking, and that changes the entire conversation about where the economy is headed overall. Investors need to watch the labor market like a hawk, because if Powell's right, we're just at the start of this cutting cycle that could reshape everything from stocks to bonds to the value of the dollar. So be sure to tune back in tomorrow. We'll talk about all of the moving pieces, all of the what's news of the day. And thanks for hanging out with me, everybody. Hope we're learning something together, and I'll see you tomorrow.